Hello, everyone. I'm David Darst. On behalf of the family office in Petiole Asset Management, welcome to the third week of April 2025. Now, this past week, we had Chair Powell make some comments about the effect of these tariffs and all the tariff news, tariff discussions, tariff threats, tariff imposition, the withdrawal of tariffs, all of this. He believes, he made the comment that it would be likely to influence inflation upward and growth potential downward. He basically cited the tension between the dual mandates of the Federal Reserve, as you know, which are price stability and employment strength. So if you're helping one, you're hurting the other, and so forth and so on. If you lower interest rates to help the labor markets, you're basically causing more inflation. If you raise interest rates to hurt inflation, you might be harming the labor markets. He said, and I'm using his words now, I'm in no rush to act on rates. That means either move them upward or downward. As of now, the Chicago Mercantile Exchange, CME, Fed Watch tool, gives the odds of no change in interest rates. The Fed policy rate, as you know, is 425 to 450. No change at the May 6th, 7th meeting. The odds right now are 87% chance of no change. The June 17th, 18th meeting, that goes down to only 37%. So there you see the likelihood, and that's where we are right now. We think there will be an interest rate reduction at the June 17th, June 18th meeting. And when you go out, if they do happen to skip that meeting, you go out to July 29th, July 30th, the odds are only 22%. So 4 out of 5 chances that there would be a cut of at least 25 basis points at the July 29th, July 30th meeting. The retail sales numbers came in for the month of March. They were up 1.4%, a very, very strong performance. However, it was a lot of buying by people wanting to get automobiles and other big ticket items before the price increases that are anticipated due to the tariffs that are coming on. The control group, that's where you take out automobiles, you take out gasoline, you take out building materials, and you take out all food services. The control group, so March was up 1.4% versus up 2%, 0.2% for February. That's the headline. The control group had a difference. It was basically 0.4% for March versus 1.3% for February. So sort of the reverse when you strip all of that out. Oil was up last week quite significantly, basically on hopes for some sort of a deal between Europe and the United States on tariffs. You had Japan in last Wednesday for talks in Washington. Nothing has been officially announced there just yet, but the Europe hopes were one of the things driving the oil price up last week. Also, the tightening of sanctions on various countries that the United States has begun to announce tightened sanctions. Empire State Manufacturing and Philly Fed. These are two regional surveys of manufacturing activity by very active parts of the United States, the northeastern United States primarily. The Empire State for April was -8, -8.1. March was -20, so it was an improvement, but it's still in negative territory. And new orders -8.8 versus -14.9. Now, the Philly Fed, that was the Empire State. That's in New York and that region in the Northeast. Then you have the Empire State, the Philly Fed, which is near the Empire State, but that's the Mid-Atlantic states. There you had -26.4, and last month it was +12.5. So you had a 38-point downward swing. I think people and especially the new orders. The new orders for the month of March were 8.7. For April, they were minus 34.2. So you see businesses beginning to take action or pause action in response to all of this tariff news and the threat of tariffs. United Health was down 24% last week. Now, United Health is a very high price stock, as you know, and it has a 9% weighting in the Dow Jones because the Dow Jones is not market capitalization weighted, it's price weighted. And so it had a significant effect on the Dow Jones last week. Anyway, the United Health was down 24.2%. It's down 10% for the year, basically because of weak earnings guidance and the weak earnings report. So weak earnings report, and the management was not giving good earnings guidance. S&P closed at 5282.70. It was down 1.5% for the week, down 10% for the year. NASDAQ down 2.6% for the week and down 15.7% for the year. And coincidentally, this is not a mistake, coincidentally, the Russell 2000 is also down 15.7% for the year. It was actually up 1.1% last week. The bank index up 1.9%, down 13.2% for the year to date. Europe was up 4% last week. So you see Europe is down only 0.2% for the year to date. Last week, you had Spain up 5.1%. You had Germany up 4.1%. You had Italy up 5.9% last week. China was up 1.3%. They're down 2% for the year. Japan was up 2.4%, and they're down 13.8% for the year. The interest rates, basically because of expectations of slowing growth, inflation, and not on the inflation side, but the slowing growth side, interest rates, the 2-year fell 15 basis points to 3.81. The 10-year fell 14 basis points to 4.31. And that basically, you might imagine the dollar was down 0.6%, and it is now down 8.5% year to date. Against the Swiss franc, for example, is even down. The Swiss franc dollar is in the neighborhood of being down 10% thus far, the dollar versus the Swiss franc. Gold, the dollar is really down a lot against gold because gold is up 25.8% year to date. 3308.70, $3,308.70 per troy ounce. That was up 2.7%. So gold is up 25.8% this year, but the gold mining shares often happens that they swing more widely up or down. They're up 50.2% for the year. Volatility eased off a little bit, but it's still high. It fell from 37.56 a week ago to 29.65 now. Looking ahead, this week on Monday, we'll have the March leading economic indicators. And, they've been down over 30 months out of the past 33 months or so. The first quarter GDP now forecast of the Atlanta Fed. So the first quarter is over, but the forecasting tool right now is showing minus 2.2%, although when you adjust for gold imports and exports, which are included in those numbers because of the subtraction of a negative trade balance from GDP, if you exclude them, the first quarter is, according to the Atlanta Fed, and we'll get a new number later this week, down 0.1% for the first quarter. Tuesday, you'll get the Standard & Poor's Flash Purchasing Managers Index for the manufacturing and for the services. We'll be watching that very carefully. It gives a very good indication as to what the final number will be later on this month. Wednesday, you're going to get March durable goods orders, and you're going to get March existing home sales. So you get to see two different parts of the economy, the industrial part and the housing part. The Friday will be the April final consumer sentiment number from the University of Michigan. We watched that very carefully on consumer sentiment, but also on the inflation expectations and the one-year expectations for the preliminary number, which came out on the 11th of this month. The preliminary number was 6.7 for April versus 5.0 for March. That was the highest since 1981. So we'll be watching that one very carefully, and I know financial markets will be watching that one very carefully to see whether that is revised downward or whether it stays in that neighborhood. That is basically a concern to the Federal Reserve. As far as positioning, we are in favor of some liquidity within the equity world, a balanced approach of growth, value, and defensives. And in the alternative space, preferred equity, also secondary market interest in private equity, structured credit, that would be collateralized loan obligations, credit and collateralized loan obligations, CLOs, equity. We like the structured credit space. In real estate, there you want to basically look for value add opportunities and opportunistic investing in the real estate space. 64% to the equity side of real estate, 36% to the fixed income side. With that, we wish everyone a very good week ahead and a good continuation, a nice, calm continuation, let's hope, for the remainder of the month of April.